Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or buy rating on my 33-question research checklist. Today, we're shining the spotlight on Rollins Inc., ticker symbol ROL, and uncovering what makes it a standout investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. I first want to talk about my investment checklist and database. My 33-question checklist evaluates companies across 9 categories, including fundamentals, management quality, industry position, fundamental and technical momentum, historical and future growth, valuation, capital allocation, and solvency and liquidity. By examining these diverse aspects, we aim to gain a holistic understanding of a company's strengths, weaknesses, and potential as an investment opportunity. In total, so far, I have screened 191 stocks across 9 different sectors. The mean quality score is a 58%. I have a standard deviation of 15%, and our top quartile benchmark is 70%. From a company size distribution standpoint, I've got large cap, mid cap, and small cap. Large cap being $10 billion plus market capitalization, mid cap being 2 to 10 billion, and small caps 250 million to 2 billion. So that distribution is 83% large caps that I've analyzed, 16% mid caps, and 1% small caps. In terms of sector distribution, the sector of stocks that I've analyzed the most is consumer discretionary at 20%, followed by information technology at 18%, industrials at 16%, healthcare at 13%, consumer staples at 9%, financials at 6%, energy at 5%, materials at 5%, and communication services at 5%. So for Rollins Inc., ticker symbol ROL, they scored a 72% quality score, which was good enough for the 81st percentile. This earns it a pass rating. We also look at Schwab and Guru Focus. So Schwab gives it a B, and Guru Focus gives it a 97, which in my database, that is in the 90th percentile. So Rollins is well liked by my initial checklist, by Schwab and Guru Focus. So the first section that we'll get into with Rollins is a business overview. There's a couple different classification systems that Rollins is classified under. If you use the GICS classification system, they are under environmental and waste services, and then industrials sector. And my other source, stockanalysis.com, has them as personal services under consumer discretionary. So for this investment research, I'm actually going to go with the latter, personal services, consumer discretionary. They are a $24 billion market cap company as of September 12th, 2024. This makes them a large cap company. In terms of their core operations, I like to break it down into their products and services and then an evolution of the company. In terms of product services, they are a provider of pest and wildlife control services, offering protection against termite damage, rodents, and insects to over 2 million residential and commercial customers. So I've deemed these as essential services for maintaining health and public safety. And the company operates through 800 company-owned and franchised locations across 70 countries. So they are a global operation. In terms of the company evolution, they have evolved from their founding in 1948 as a small pest control company to a global leader in the industry, primarily through strategic acquisitions and focusing on recurring revenue. The company has expanded its services and geographical reach, which has essentially solidified its position as a leader in the pest control market. So the next area that I like to review for their business is business segments and geographies. If you read their 10K, they actually only have one segment and 3 different service offerings is sort of the way they've defined it. The first one is residential services, which is providing those pest control solutions to homeowners, including common treatments for pests, termites, and mosquitoes. This makes up around 45% of net revenue. We've also got the commercial services, and this is catering to business like restaurants, hotels, and schools with specialized pest management services that meet certain health standards. This side of the business is around 33% of net revenue, And so that leaves us with around 20% revenue that goes to their third service, which is termite and wood destroying insect control. So these are inspections and treatments for both residential and commercial clients. Their most well-known brands are Orkin. It's their crown jewel of the portfolio. They also have some well-known brands like Home Team Pest Defense, which is for new home construction pest control, and also Northwest Exterminating, which is a strong regional player in the Southeast United States. I also like to then look at their geographies. Rollins mostly operates in the United States. It's 93% of net income, but they do have some international business in Canada, Australia, and the UK, around 7%. So the next section that we'd like to look at is understanding their customer base and market dynamics. First thing with customer base is I do note that they're diversified across residential and commercial sectors. So really no customer concentration risk there that I saw as well in the 10K. I also like to look into their core customer a little bit, which I feel like is often overlooked in the investing world. So I want to first talk about residential customers. The way I've sort of painted the picture psychographically with this group is they're typically going to be homeowners or renters, age 30 to 65. They could be living in urban, suburban, or even rural areas. They're often middle to upper middle class individuals and families who are concerned about property value and home maintenance. And then now shifting gears to commercial customers, this group includes small to medium-sized businesses, especially in sectors like healthcare, food service, and logistics. Think, property managers and facility maintenance professionals. So these customers are a little bit more focused on workplace safety and hygiene, and they're often corporate decision makers who understand the importance of a clean environment for their brand's reputation. Next, let's understand a little bit of seasonality in this business. So weather conditions do significantly impact pest and termite control services, which leads to increased revenue during the spring and summer months, which are pest activity peaks. And this seasonal pattern is also reflected in their quarterly profitability, which is higher in the second and third quarters compared to the first and fourth quarter. So that's one thing to understand when analyzing Rollins as a business. Next, I like to look in their competitive advantage and competitors. The U.S. pest control industry has actually experienced consistent growth for the last 15 to 20 years, but higher interest rates and volatile housing costs have created some short-term headwinds in this industry. That's one thing to kind of take note of here. And Rollins, with their well-known Orkin brand, remained the market leader in the United States, so much so that Morningstar gives them a wide moat due to their low cost advantage. And this competitive advantage is also shown in brand strength, as I mentioned, high customer retention rates, and strong financial profile. I also looked at Comparably, which is a website that will analyze different businesses on certain customer metrics. Rollins actually boasts a 76% customer loyalty rating and a fairly impressive, at least compared to some of their competitors, +9 Net Promoter Score NPS rating. So now let's look into some of their key competitors. The biggest competitor, and this is a United Kingdom company, Rentokil, which I make sure I'm pronouncing that right, Rentokil Initial. Their ticker symbol is RTO. They are a $15 billion market cap company based in the UK, as I mentioned, and they are a formidable global competitor that Morningstar also gave a wide moat rating to. However, one thing to call it with RTO is that organic growth remains weighed down by some ongoing integration challenges from their 2022 acquisition of an industry competitor, Terminix, for around $13 billion. So while Rentokil carries more debt, it does trade at a lower multiple compared to Rollins. So this would be a potential company to look for if you think Rollins' valuation is too high and you're looking for sort of another player in the industry. However, I did want to call it too that their customer metrics do lag behind Rollins. They have a 65% loyalty rating and a -10 NPS. There's two other competitors that we'll talk about. One is called Anticimex, a Swedish company, and they are rapidly expanding their global presence, particularly in the US market. One thing with them is that they are backed by private equity, so they're focusing on that sort of aggressive growth and digital solutions as well. Unfortunately, we don't have enough data on their customer metrics for comparison here. Last, we'll talk about Ecolab, ticker symbol ECL. They are a $70 billion market cap company and another major player in the pest control industry. But one thing with them is that pest control is just one segment of their diverse portfolio, which also includes water, hygiene, and energy technologies. So maybe less of a direct competitor, but still sort of also involved in the industry. They do show strong customer loyalty with a 77% rating on Comparably, but their NPS is much lower than Rollins at -8. Okay, so now I want to get into a little bit of business model and high quality attributes. What makes Rollins sort of stand out as a quality company? So their revenue model is that they generate revenue through a combination of company-owned locations, franchisees, and pest control brands as subsidiaries. They then recognize revenue upon transfer of control of their services to customers. So pretty straightforward there. They also do call out in their 2024 investor presentation that recurring revenue is more than 75% of net revenue. I would love to see this tracked on a quarterly basis or even in their 10K, but it's good to know that at least their investor presentation has that. They do call out in the 10K that residential and commercial services are primarily recurring on a monthly, bi-monthly, or quarterly basis, and that pest control customers sign an initial 1-year contract. So there are a couple call outs there. In terms of marketing and distribution, so marketing strategies are not directly called out in the 10K, and advertising expenses are actually included with SG&A on the income statement. So for the purposes of their evaluation, I'm assuming that marketing strategies are not particularly relevant for this type of company. So we'll next go into distribution channels. Their distribution channels are mainly through direct services and then their franchisee operations. The next bucket is production and pricing. So I want to talk a little bit about their manufacturing, pricing power, and supply control. From a manufacturing perspective, they actually rely on a vast network of national manufacturers and suppliers rather than manufacturing their own products. So that's one thing that is a little bit unique with their business model. In terms of pricing power, I did rate them as strong. So they note this in the 10K, but they're able to essentially consistently raise prices above inflation, which is always what you want to see from a business. And I also have that demand for their services is more inelastic. You can't really put off pest problems at home, at least not for too long. And I've also noted that pest control is typically a small portion of a customer's overall budget. So I think this is one thing that's benefiting their pricing power. Lastly, they do also have brand recognition, especially with Orkin. So I think there's some pricing power in the brand strength as well. I also like to look at supply control. I've rated supply control as moderate. Pest control services is a highly fragmented market, and I did a rough market share estimate for Rollins, and I came up with around 12% based on their 2023 revenue and a global pest control market size of $26 billion. They do have some degree of supply influence. They're actively acquiring smaller pest control companies and effectively consolidating the market and reducing competition. But it is so fragmented that there's only so much they can control in total. In terms of the quality attributes next, after looking at their business model, qualitative attributes, I have two buckets, strategic positioning and then financial stability. Within strategic positioning, I have market leadership, and Rollins has strong market leadership through its flagship brand Orkin and their estimated 12% market share in a fragmented industry. And then the second thing under strategic positioning I've noted is stock appeal. I've noted that they have characteristics of the very attractive owner-operator business sort of stock appeal or type, with a long history of family involvement in management that we'll discuss here in a few minutes. And for financial stability, I've got two things: recurring revenue and resilience. Their business model is based on recurring service contracts and regular treatments, which provide stable and predictable income streams for investors. And then from a resilience perspective, very impressively, they've maintained revenue growth of, I've noted here, approximately 6% during economic crises like the 2008 to 2010 great financial crisis. And then they had around 12% revenue growth during the 2020 to 2022 COVID pandemic years. And most impressively, they've actually grown revenue every year for almost 30 years, if not 30 years exactly. So very impressive from the qualitative standpoint. And then quantitative high quality attributes. First of all, one of the first things I like to look for is have they been in the market in Portfolio Visualizer since tracking began? The answer to that for Rollins is yes. They've generated a annual price CAGR of 16.5% versus the S&P 500 of 9.1% since Portfolio Visualizing Tracker began. That's great to see. Guru Focus also rates them as a highly predictable business, getting a 4.5 out of 5 stars. And you'll see some research online around the higher the Guru Focus predictability score, the better the stock performs. They also have a 10-year free cash flow linearity of 0.92, which is well above my 0.75 benchmark. So very highly predictable business that has beaten the S&P 500 since inception. I also like to look at margins. So their 10-year average gross margin is 51.1% as of 2023, which is well above my 40% threshold. And their 10-year average stock-based compensation adjusted free cash flow margin is 13.6%, which is actually slightly below my 15% threshold. But it is noting that for the last 4 years, that 2020 to 2023 time period, the free cash flow margin has consistently been above 15%. So great margin and profitability profile as well. I also like to learn a little bit more about, are they a quality growth company? And if you look at their 10-year revenue growth CAGR, I like to look at anything over 5%. They're at 8.1%. If you also look at their 10-year free cash flow per share CAGR, I like anything above 10%. They're at 11.7%. And then finally, I like to look at their 10-year average free cash flow conversion, which is free cash flow per share divided by net income per share, is at over 100%. And the answer is yes. They're at 121.1%. So great to see that from a quality growth perspective. And then I also like to look at returns on capital. Do they have high returns on capital to go with that growth? I first like to look and see on a 10-year basis, is their average ROIC over 20%? The answer is yes, it's at 25.4%. And then is their current ROIC greater than or equal to at least 2% of the WACC? This I have to use Guru Focus, but as of September 24, their ROIC is actually 9% higher than their WACC, which is well above my 2% benchmark. So you want to make sure that ROIC is always over the cost of capital, and they score very well in that. The next area I like to look at is growth opportunities and risk factors. So from a growth areas perspective, I've noted a few things, and there's definitely more, and please provide comments and let me know other growth areas and other risks you see with this business. For growth, I've got market consolidation through strategic acquisitions. They also can increase their franchise programs. Right now, they have 138 franchise operations domestically as of last year, which is up 3 from 2021. We'd like to see this more than 3 over the last couple of years, but this is an area for them to continue growing. One thing to call it, though, I've noted international is a great opportunity to expand as well, but they're actually declining. Their international franchisees have declined by 17 from 2021. A couple other areas of growth I've noted is further improvement from their virtual route manager technology to enhance productivity. Type in Rollins and virtual route manager technology. They're using technology and AI to enhance worker productivity, getting them to the locations faster, being more efficient while they're there. That's an area it sounds like they still can continue to improve on. And then also expanding to new services. So maybe sustainable solutions I've noted, or smart monitoring, but doing sort of new services could also be a growth area for them. And then in terms of risk areas, so they have relatively low barriers to enter the industry. In theory, you could start a pest control business in your local neighborhood fairly easily. There's obviously some scale disadvantages to that some of these players like Rollins have. But in terms of actually entering the industry, it's not a huge barrier like some industries out there. There's also a lot of pest control M&A competition heating up. I noted this a little bit with some of the competition section, and this really does put upward pressure on deal multiples. A couple of other things. So they have a high goodwill percentage of assets, which we'll talk about a little bit more next in the financial statement overview. And that just has future impairment risk if they have to write down bad acquisitions. We've also got supply chain vulnerabilities because they do rely on this vast network. They have less control over some of the supply chain. So that's something to think about and to watch. And then also their high valuation, which we'll get into at the end of the podcast. But they have a very, very high valuation by most metrics. Okay, so then next we want to talk about, I like to look at the just a very high level financial statement overview. So I always like to first start the income statement. And actually for Rollins, I don't have too much to report on their income statement. I've mostly noted that operating expenses is grouped as sales, general, and administrative, SG&A, which they note includes personnel, advertising, and amortization of capitalized costs. For me, I like when companies actually break this out into R&D, marketing, and a couple different line items. There's a couple ways to kind of interpret that, but that's one thing to note there for them. This line item was about 30% of revenue in 2023, and that's consistent with 2022. And from just reading the R&D section of their 10K, it doesn't seem a significant portion to this business, so perhaps that's why everything's grouped together. I also like to just look at the interest coverage ratio. Is it greater than 10? I think Benjamin Graham used to have a benchmark of greater than 3 or 5. I like to maybe double that and see if we really have a company that can pay back its debt. Rollins clears this significantly. So their interest coverage ratio as of the last fiscal year 23 was 30.9 on Guru Focus. So that's great to see. And then a little bit about the balance sheet with them. So I mentioned previously, their goodwill percentage of total assets is high. It is 41.2% right now. And other large assets include customer contracts and operating lease ROUs. So that's to be expected. Their largest liability is long-term debt, which is 34% of liabilities, and then operating lease liabilities as well. I also like to look at their trailing 12-month debt to equity ratio on stockanalysis.com. This is 71%, which is very manageable and below my 150% threshold. So this means that they have 71 cents of debt for every $1 of equity. And for me, you can get up to about 1.5 times debt to equity before it gets a little suspicious or a red flag. But with debt to equity, kind of the next step further is looking at their cash to debt ratio. You could also just look at their net cash or net debt position. Their cash to debt ratio is a little low at 0.13. That means they only have, for all the debt they have, they only can cover 13% of that with cash. And that is as of fiscal year 23 on Guru Focus. I ideally like that to be over or at least at 1.0 or above. Okay, so lastly, we'll go into the cash flow statement. And just 3 things I have written down for the cash flow statement is stock-based compensation consistently less than 10% of revenue. You can also look at it as a percentage of operating cash flow. In this case, not a problem at all for Rollins. They're actually at less than 1%. Their 10-year average is 0.70% for stock-based compensation as a percentage of revenue. The next thing is looking at CapEx spend as a percentage of revenue. Ideally, I like capital light businesses. Rollins does clear my less than 5% of revenue benchmark here. Their CapEx percentage of revenue for the last 10 years is 1.6%. I did want to also note for Rollins that they do buy back shares and give a dividend, and they also have a little bit of M&A. So we'll next talk about their management. I first want to talk on a little bit of a leadership overview. So they're no longer directly founder-led, but they are family-owned. And just a little bit more about the family. So Gary Rollins was CEO for the last 20 plus years before stepping down in January 23, when Jerry E., and I hope we're pronouncing this right, Goloff Jr. took over the role as part of his succession strategy. And so he's now been in the role for a year and about 9 months, which is shorter than the U.S. average CEO tenure of around 4.5 to 5 years. But I did want to note Jerry has been with Rollins for over 15 years. One other thing with leadership that I do like to look at is just browsing their Glassdoor page as well for the company. They only have 281 total reviews. Their likelihood to recommend friend rating is 63%. This rate's actually around the 22nd percentile in my database, fairly low. My top quartile benchmark is around 82%, which, Rollins is significantly below that. Around 63% of employees have a positive business outlook. Overall, I've got this as decent, but not great. In terms of the leadership, though, it sounds like the CEO, despite not being there for a long time, has been with the business for a while. And I'll also talk about the Rollins family a little bit more and kind of why I feel comfortable with management here in just a few minutes. In terms of their management compensation and incentives, I break this sort of section down into philosophy, structure, and KPIs. From a compensation philosophy standpoint, Rollins employs a pay for performance approach, with approximately 80% of executive compensation being quote unquote at risk and directly linked to company performance. The current CEO has 85% of his pay variable compensation. So this is, to me, I've noted here, generally good to see. In terms of their compensation structure, there's three elements. So the first one is base salary. The second one is performance-based cash incentives. And the third one is equity incentives. Base salary is fixed cash compensation, while performance-based cash incentives and equity incentives are those variable components. I also just like to look and see what sort of their KPIs are. And their 2023 bonus plan is based on two performance goals. Revenue to plan, so it's a year-over-year revenue growth metric, which they want to achieve. They wrote here 7.8% year-over-year revenue growth, and then a pre-tax profit plan achievement, which is interesting because there was no performance goal listed in the 14A, but the company does mention that it's the most important financial measure. So unless I missed that, I did find that interesting that there was no goal for a operating margin or sort of something like that. So it might not be a big deal, but a little odd nonetheless. From a capital allocation standpoint, Rollins does get a standard Morningstar capital allocation rating. Of note, competitors Ecolab and Rentokil actually got exemplary. Morningstar suggests that the company could be more aggressive in their acquisition strategy. They give an example of the fast-growing Asian pest control market as an area of growth. With that said, though, their shareholder distribution policies are deemed appropriate by Morningstar, so giving dividends and buybacks. They do note in some of their investor presentations that most of their free cash flow and cash is allocated to M&A first. So that's one thing. Some investors do not want M&A sort of to be a first usage of cash or free cash flow. So that's one thing to call out with Rollins here. They do that first. Then dividends and then buybacks is a lower priority. So just something to think about there. Diluted shares outstanding standpoint, over the last 5 years, it has decreased by 0.2%, which is nice to see. Would love to see that at maybe 1%, but they are decreasing shares. I've also got their 5-year average total shareholder distribution, which is taking dividends plus buybacks divided by free cash flow at 64.5%. And generally, that is really good because what you want to see is it consistently below 100%. If you're paying out more in dividends and buybacks than free cash flow, then you've got to start raising debt eventually. Essentially, if you can stay kind of below 100%, the company will be running very well. From an ownership structure standpoint, I did want to talk a little bit more about, now this is kind of why I feel a little bit better about management, is in 2023, so the Rollins family unloaded a 9% stake in the company, but they still own anywhere between 35 and 40% of the business, which is significantly higher than my benchmark of 15% for insider ownership. And so as I've noted here, because inside ownership is high, sort of that management compensation above matter is just a little bit less. Also, I like to just look at institutional ownership. So right now that's around 50 to 55%, which is a little below my benchmark of around 70 to 75%, but that's likely due to the high insider ownership, so not a big deal for me there. Next, I want to talk a little bit about valuation and then technical analysis. So for valuation, as I noted in my first episode, there's really 5 different valuation metrics that I like to look at. The first one being just a regular DCF, and I get this from investorsgrow.com. For a regular DCF, if you use a 9% required return, a 2.5% perpetual growth rate, and then 3 years of analyst free cash flow forecast, you'll get Rollins fair value at around $20, which is over 145% above the current price. I also like to look at a reverse DCF. The source I use for that is Stock Investor IQ. And so using trailing 12-month free cash flow per share, a 9% required return, and then if you use a conservative or average sort of S&P 500 price to free cash flow terminal multiple of 15, Rollins needs free cash flow per share to grow 16 to 18% per year for 10 years to justify their current price. Actually, fairly higher than their 10-year average of 11.7%, which would also indicate a little overvalued right now. The next metric I like to look at is just a trailing 12-month free cash flow yield. Got their trailing 12-month free cash flow yield at 2.09% versus a 10-year average of 2.57%, indicating that Rollins is currently valued higher relative to its cash flow generation historical average. The next two sources I like to use from Guru Focus, so their EV to EBIT and their EV to revenue, so two multiples. Their EV to EBIT is currently at 38.27 versus a 10-year median of 36.94. This suggests that they're currently valued about 3% or so higher relative to their operating profits than its historical average. And then for EV to revenue, I've got it at 7.66 versus a 10-year median of 6.64. This also suggests that they're overvalued. This time it's a little bit higher, around 15% relative to its revenue versus its historical average. So looking at all valuation metrics, they appear to be overvalued right now. I also just like to look at a very little bit of technical analysis, and I get that from TradingView. Really what I want to know is, are they on a long-term price uptrend, and what's their current price versus the 1 year and 5 year 200-day exponential moving average. Are they on a long-term price uptrend? Yes. Their current price is actually about 8% above the 1 year 200-day estimated moving average and 29% above the 5 year 200-day exponential moving average. And prices significantly above the long-term moving averages often suggest bullish momentum. From a technical perspective, they look pretty good right now. Overall, Rollins is a leading pest control company with a recession-resistant business model. The company has positioned itself as a long-term compounder with strong free cash flow dynamics that enable high returns on and of capital. Despite trading at a premium valuation, Rollins' market leadership, high customer retention rates, and ability to consistently raise prices make it an attractive long-term investment for investors seeking a quality business with defensive characteristics and a steady mid to high single-digit organic top-line growth with accretive M&A. What do I plan to do with Rollins? I plan to add it to my watch list with a buy range of $30 to $35. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Rollins Inc., ticker symbol ROL, both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, or drop a comment. Your feedback helps us grow. For real-time updates and insights, follow me on Twitter or X at Invest091. Join me in 1 week when we'll dive into Gartner Inc., ticker symbol IT. Until then, keep your investments smart.